Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So one of the things that I really like doing is researching stocks all day. Genuinely, if I get the time, I just like to just go online and just find some of the best companies out there, see how much they have grown over the last whatever years. Recently I was just doing a bit of research and I thought, you know what, let me share this with the community. What I was trying to do is find companies that have grown in terms of revenue side of things and EPS side of things about 15% or higher, and I found 7 companies that grew their revenue over 15% per year over the last 5 years. And some of these companies, one thing I found interesting was the fact that all of them are expected to grow more or less the same in the coming years. So, which is interesting. So, not only have they done well over the last 5 years, they are going to do well over the next whatever years. So, I'm going to share that with you guys today. 7 companies that grew their revenue, about 15% revenue and EPS 15% or higher. Now, one of the things I would definitely like you guys to do is be careful, because a lot of these companies right now are overvalued. Okay, and I'm just sharing this with you guys to show you what's out there. And of course, you can add it to your watch list, have your price target, and leave them alone, because some of them are quite expensive. And it's always important. I've always said to you guys, just don't buy this stock because we talked about it. It doesn't mean it's a buy right now. And I don't just want to share all the time companies that are buy right now. Yes, we like to buy them when they're cheap. I'll let you guys know when I think the company is cheap based on the fundamentals, based on the information that is available to me. And then, of course, then you're going to have to do your own research. And please be careful, because right now there is so much going on in terms of the stock market. And right now, again, the other thing is everything seems overvalued. So you have to be really, really careful. So what I'm going to do now is I'm going to share with these 7 companies. I'll give you a little bit of detail about each one of the companies, and we'll look at fast graph as well to see what basically the difference between the price target from fast graph and from Morningstar, and what fast graph actually also thinks about in terms of that stock. If you haven't liked the video, please like the video, subscribe to the channel. If you haven't joined us at the Patreon account, please do so. It genuinely helps the channel and you get a lot out of it, inshallah. So let's get started. So the first thing we're looking at is basically the basic stuff. There's no dividends. Majority of these companies do not pay any dividends. So we're going to focus on the 5-year revenue growth, 5 years in terms of EPS. We're going to look at the EPS and revenue as well going forward. And then on top of that, we want to see how effective the management is, competition side of things, free cash flow side of things, and then the Morningstar valuation. That's exactly what we're going to do. So the first company that we're going to look at today is Arista Networks. This has been one of the companies that has been on my watch list and my, under my radar for quite some time. It's a huge company, 144 billion market cap, wide moat, $118 per share right now. The 5-year growth rate when it comes to revenue is been 25% basically over the last 5 years on average, which is absolutely amazing. EPS about 32%. Profit margin, return on equity, return on invested capital is absolutely amazing. And then you've got, $3 billion, over $3.5 billion, $3.7 billion of free cash flow right now. They're expecting the earnings to grow about 17%, revenue about 18%. And when you see this company, like the company has done absolutely amazing in terms of growing revenue, it's a fast growing company. And top of that, you've got growth expected to be high double digits in the next couple of years, then of course it's going to be expensive. You know what I mean? It's not going to be cheap. That's one of the reasons why a lot of these companies are expensive, because of the fact that they are high. They've got fast growth coming up in the next, so they're growing their revenue and EPS quite fast over the next whatever years. Now, if we look at just the forecast side of things, okay, in fact, I'm just going to show you historically, okay, over the last whatever years where the company's been. So there's been times when 2016, 2017, and then since then it's come down again, it's gone up. So there's been times where the company was actually, this black line here was under the orange line, which means basically the stock was undervalued at that point. And then of course we got to 2023, and then the company took off, and then it has come down quite a bit, and then it's gone up again. So it's interesting to see that basically how the company has, and we were talking about at some point, we were talking about 60% EPS growth basically, and then 52%, 31%, 14%, 16%, and right now we're looking about 19% in 2027. So if we look at the forecast moving forward, normal estimates, okay, you will definitely know that it's going to be expensive. It's almost about you losing about 50%. Your 10,000 becomes 5,000 basically. And then if we look at the normal multiples, this is always the case. Like, you know, you're going to make a little bit of money, about 600 if you bought it right now, but you're taking a huge risk, okay? And there's no, I don't think you would have any margin of safety in terms of that one. So I wouldn't touch it right now, but it's a great company. It's a high growth company. And another one is AppLovin. This is 123 billion market cap. It has a narrow moat. And right now, as you can see here, we've got the 5-year average for the revenue side of it, which is 32%, 95% when it comes to EPS. In terms of the profitability side of things, absolutely amazing. Return on equity is really good, $2.5 billion of free cash flow, and they are expecting the earnings to grow 41% next year. That's 2026, and revenue 22%. It's 15% upside from where we are right now. Downside from where we are. So if you bought it right now, according to this, you will be losing about 15% of your money. Now, if we look at fast graph, as you can see here, okay, right now if you bought the stock based on the normal estimate, this 38%, 25%, 81%, whatever this is, right? If we based on that, it actually seems cheap. Okay, your 10,000 will become $15,000, okay, by the end of 2027. So that's based on the estimates. Even if we use normal multiple, okay, is even becomes cheaper, 125% on the based on your money. So that's $22,569 basically that you will be making on the top of your money. So it's really interesting the fact that this one, you basically, according to Morningstar valuation, it seems overvalued, but here it seems actually undervalued. But if you look at the estimates, if you look at the normal multiples, this, when we say normal multiples, we look at the 5-year average is basically for the PE side of things. So it is interesting the fact that this one actually seems cheap right now. And I think let me just go to Seeking Alpha. Because Seeking Alpha, yeah, there we go. So it's strong buy from Quant. Wall Street saying it's a buy. Seeking Alpha analyst is saying it's a buy. So it's an interesting company. They're all around basically. These are saying all a buy. Arm Holdings is the next one, 172 billion market cap. It has a wide moat, $163 per share right now. Basically, last 5 years. I think this was I can't remember what it was, but it is not for last 5 years. I think it's less than that. I think it was about 3 years that I looked at, because the company has only become public company for basically quite recently. So 24%, 159%, 59%. Profitability side of things is really good. Free cash flow is very small, and they expected the earnings to grow about 33%, revenue about 22%, over 50% basically overvalued according to Morningstar. And you wouldn't be surprised, of course, there's no surprise here. You'll be losing about 60% when it comes to the normal estimates. If we use a normal multiple, and you'll be making about 45%. Basically, your 10,000 will become $14,516. The next one is CrowdStrike. CrowdStrike Holdings is one of the companies that I've had in my portfolio. Sold it a long time ago. I wish I never sold it. But I took some profit off the table at that point. 117 billion market cap, narrow moat. And as you can see here, 56% and 49% when it comes to the growth side of things of the last whatever years. Profitability is not there yet. They've got free cash flow, $1 billion, which is nice. They're expecting the earnings to grow about 31%, 35%, and revenue about 22%, about 29% basically downside from where we are right now. If you bought this stock right now, basically their price target is $330 per share, but right now we're looking at $465 per share, so a bit expensive. Again, same situation. If you look at the normal estimates, which is basically this 30% of basic growth in terms of EPS side of things, you will be losing about 72% of your money. If we use the normal multiple for this company, you would be making about 100% of your money. Basically, your 10,000 will become 20,000 USD. So again, interesting the fact that if we use a normal multiple, which is basically what the market likes to trade this company, these companies seem slightly cheaper. But then again, you need to give yourself that basically 10% margin of safety. DexCom is another one. Basically, right now market cap of almost $35 billion. It has a narrow moat. You can see in terms of the last 5 years, we're looking at basically 24% and 37% when it comes to revenue and EPS. Profitability side of it is decent. They've got about 500 million, just over 500 million in terms of free cash flow, which is good. 24% when it comes to growth estimate for EPS. Revenue about 15%. Only 7% basically downside from where we are now. I say only, but if you add another 5 to 10% on the top of that, if you're really interested in the company to give yourself margin of safety, of course, then it has to come down quite a bit. So $83 per share is where they think the price should be right now. Is about $89 per share. So 83, 89, not much of a difference, but of course you have to be careful. And again, we got similar sort of a situation. If we use the normal estimates, it seems very expensive. If you use the normal multiple for the last 5 years, is very cheap right now. $287, basically 287 basically percent upside from where we are right now. So your 10,000 will become 38,786. Now that's really interesting because based on the normal multiple, which is but then 112 PE, that's basically what we're looking at. That multiple is absolutely ridiculous, but despite the fact that the company is expected to grow massively, about 24%, almost 25%, 21%, and so on. It is still, to me, in my opinion, that it seems very expensive stock to buy right now with that sort of a PE. Now, the other thing you can do also when it comes to, you can basically compare it, the 5-year average, with where the current PE is and so on, and then that will give you an indication. And use also PEG ratios. PEG ratio is quite good for these companies. I haven't included it in here, maybe I should have, but PEG ratio is another basically metrics that you can actually use to value high growth companies. Now the next one is KLA. KLA Corporation has actually done quite, I was surprised to see on this list because it's done really well. It's another one that I used to own back in the days. In terms of the revenue side, we're looking at about 17%, with EPS 33%. Profitability is absolutely amazing, excellent free cash flow, but they're expecting the earnings to grow about 3% and 3% when revenue as well, so not great moving forward. But because this company is a semiconductor, it is actually one of the cyclical businesses, if you like. Okay, so you have to take that into consideration when you buy this company or put it in your watch list. Some years they do really well and they grow fast, and some years they don't. So, but on average, they are basically do above the market, if you like. Again, I just wanted to show you this. Basically, look at this, how the company has been absolutely fine in terms of tracking the orange line, which is the earnings side of things. And then all of a sudden, we basically seen a massive pull up in 2022, when the market crashed with it, especially tech companies actually went down a lot. And then since then, it's been going up and up every single year. Now, if we just focus on the forecast moving forward, using the normal estimates right now, if you bought it, you'll be losing about 33% of your money. If you basically use the normal multiple for this one, you will still be losing 16%. So the company, because there's not much of a growth there right now, that 2%, 3%, that 13% in 2027 and 2028, we're looking about just 3%, and right now it's about 3% next year. That's not a lot. So that's probably one of the reasons why, based on the estimates, based on the normal multiples where the company has been, the normal multiples has actually been at 18. So that's probably one of the reasons. So yeah, it seems very expensive right now. I wouldn't touch it. The final company is On Holdings. This is the one I wish I bought a while ago. I came across the company when I saw the shoes and basically people wearing it every single day. You go to JD, they're everywhere. There's like 150 to 170 pounds per pair. And that's when I started doing a little bit of research. At the time it was trading, I would think about 20 something, 30 US dollars. But I just didn't do enough research to actually buy. But look at the growth side of things. The last 5 years, we're looking about 43%, 51%. EPS were basically 35%. Revenue at 24%, expected to grow. So really good moving forward. And if we just go on here and check out what the company, especially if we just go back history side of things, you can see the company has only been around for a couple of years, and they're expecting to grow about 8%, 33%, and 31% in the next couple of years. So if we just use the forecast here and using that normal estimates, if you bought the stock right now, you'll be making about 6%, which is decent based on that 27 PE. Now, if you use the normal multiples, which is that 57, then you'll be making 123% on your money. So your 10,000 will become 22,000. So all of these companies are really great companies. They've done well, and I think they're going to do well over the next whatever years, apart from this one, which is basically a little bit of a question mark. But all of them seem very expensive. Apart, this one seems basically probably the one that I would do a little bit more research right now if I were basically on your shoes, and just figure out a little bit more about the company and why basically when it comes to here they actually saying a strong buy. And then look at the matrix as well. I love this. I love how basically all of this is in the green, basically. Like, it's absolutely amazing to see the growth side of it. But when you click valuation again, basically that 5-year average of 30, and right now we're looking about 50 40 in terms of PE. So you have to be careful when you buy these companies, because you can buy a great company when it's overvalued and lose a lot of money. Okay, but if you buy a great company when they're undervalued, you will make a lot of money. I promise you. Like, I have seen that with Broadcom. I was buying this company when it was very much undervalued, and I always talk about it because I genuinely, like, I'm not showing off or anything. I've got companies that are down so much, and that's absolutely fine. And I bought it when they were over basically priced at the time, or maybe the sentiment has changed and things slightly became different, where the dynamics of the company, like for example UPS, changing from working with companies like Amazon and saying no, we're not going to work with Amazon anymore. We're going to be distance basically ourselves from that company so we can actually have a better margins and so and so. But the market did not like that, and the stock tanked. But you can also get companies like this one here, Broadcom and Visas, and basically all of these companies that are in the green when you buy them when they're cheap. Then of course, like this one, I genuinely like over 500% up. And I was buying when it's really, really cheap. I wish I bought more at the time. But again, it's in hindsight, like at the time I didn't know. Okay, so this is why it's always important to basically do your own research, not just rely on somebody else's, like what I'm saying or whatever. I'm human. I can, like, right now, you see all these amazing greens. Go all the way down. You can see, like, for some companies like UPS, I'm down over £3,000. Okay, which is absolutely fine because I have a plan and I know exactly what my plan is. So there are companies in the red in my portfolio, and that's normal. You're not gonna be a portfolio manager and have everything in the green. And if you do, well done to you, honestly. So yeah, inshallah, hopefully let's see how it goes. But one of the things that I would definitely tell you right now is some of these companies are overvalued. So please do your own research, find out a bit more information, and then take it from there. If you haven't joined us the Patreon account, please do so. Genuinely helps the channel. Anyway, have a wonderful day. Assalamu Alaikum.